Perfect. Okay, so nice to meet all of you. Again, I saw some familiar faces. If you are using SeedLegals already or Swoop, that's awesome to see you here today. Thank you as well for coming, because I know it's a beautiful day and most people want to be just outside, so cool for the engagement. This webinar is going to be about what investors look for in a company. And as mentioned, we have Tom here from Swoop. So Tom, do you want to present yourself?
Yeah, thank you very much, Julia. Yeah, so nice to meet you, everyone. Yeah, thanks very much for coming on. My name's Tom. I work at Swoop Funding. I've been at Swoop for about 2.5 years now. So we're essentially a platform that matches businesses to all different types of funding solutions across debt, equity, and grants. I work specifically on the equity side of Swoop, where we have a big network of investors, and we help startups go out to raise and match them to investors and look to get them introduced to the right investor as well. So yeah, looking forward to sort of giving a bit more insight into the type of things we've been seeing over the last sort of 2.5 years, and hopefully you find it useful today.
Yeah, awesome. And for me, I think I've met some of you already, but I'm an account manager at SeedLegals. So I've been at SeedLegals for a while. My day-to-day consists of speaking to founders like yourselves and helping them get investment ready, defining the right raising strategy. So we have a lot of, agile ways to do that. So I'm always happy to answer any questions that you have. You can reach out to us, obviously, on the Q&A or LinkedIn. And any question is never a stupid question. So we're happy to answer anything. So let's get right to it. So who are the right kind of investors for you? Tom, if you want to hop in.
Yeah, nice one. So yeah, I guess like this whole webinar is kind of about finding out what investors look for, but then also important to sort of work out which investor is right for you. And even before that, it's probably important to ask yourself, are you ready for investment, and should you go out like right now to go and raise? So if you've been bootstrapping for, I guess, a year or two, and it's going quite well, you think you're getting to a stage where you should go out and get investment. I'd always recommend just having a sort of taking a step back and having a think, like, am I quite ready to go out? Because it's quite an extensive process. It will take up quite a lot of your time. So you don't want to go out too early and then find out that you actually weren't quite ready and you don't raise the money that you wanted to. Also, getting investors on early days is obviously a tiny bit more pressure. You've got to be sort of reporting on KPIs and things like that as well. So these are things you want to think about before going out. And also, you need to make sure that you've proven the market. So just make sure that there is a market out there for your products before going out. So you might have done some testing, done some surveys. You might have even got some early traction as well. These are great ways of proving the market. We also have a bit of a scorecard, which we can share afterwards as well, which kind of identifies sort of milestones that you might want to hit before going out to investment. And so, but if you do think you're ready and you want to go out, there's a few different ways that you can raise, and I'm going to identify a few. So obviously we can help with raising investment, and we're always happy to speak to people. So if you do have any questions, feel free to follow up. We have a team of equity funding managers at Swoop. We're always happy to answer questions. Can tell you if we think you are ready and what kind of investor you might be suited to. If you're doing an early raise, it's always worthwhile reaching out to your network. There might be a colleague, ex-colleague, or a friend of a friend that might have invested in a few early stage companies. And if you can sort of connect with these people that are sort of close to you, then that's quite a good way of getting early investment in as well. And online, there's all sorts of investor lists and networks that you can reach out to as well. So if you just had a Google and tried to find an extensive list, you'll be able to find one in minutes, and you can start reaching out to people. Something as simple as that. There's things like the Angel Investment Network, crowdfunding platforms, and that kind of thing as well. And obviously, if you are early stage, you might be suited to an angel investor. Finding angel investors is obviously sometimes quite a tricky thing to do. So you just really need to put yourself out there, get yourself out to events and things like that. So you might have seen that there's like London Tech Week on this week, different events, really good to just sort of get yourself out there. You never know who you might bump into, and you might meet your angel investor at an event, or say like an angel dinner or something like that. Pitch events are a really good thing to do. I know Swoop and SeedLegals both do pitch events. They're a good way of getting yourself out there. And like you say, you never know who's watching. You might have some big VCs who want to sort of keep an eye on you, or you might have an angel investor on there who's ready to invest straight away. And then also LinkedIn is a very powerful tool. And although it can be quite laborious kind of going through and finding different connections, a lot of good connections can be made. And if you find the right investor on there, it's definitely worthwhile. Could you skip to the next slide, please, Julia? Thank you.
Yeah.
And I just wanted to identify a couple of other sort of funding routes as well. So as well as sort of going out to VCs and looking to get a venture capital fund in early doors, you can also explore things like crowdfunding. So obviously it's a really good option in terms of building out a community for your business. It can be particularly good for B2C companies as well, because you might have a few loyal customers that have bought your product in the past and they want to get on board and kind of join on the funding journey. I guess a few things to kind of mention those that often before going on to these platforms, you often need to have quite a lot of the investment already bought in as a cornerstone. So you often might need, say, 50% of the round already committed before going onto the platform. So it's important to sort of secure your early stage cornerstone investors as early as possible. Then if you do go onto the platform, you have to be sort of, it's a bit of a full-time job. You're reaching out to as many people as possible. You'll have lots of marketing materials, but then hopefully you get into this stage where you're overfunding. So essentially that's where you've hit your full target and it makes you look really attractive to other investors on the platform. There's a bit of a fear of missing out when people see these businesses in that stage. And then another one to sort of call out, I think, is regional funds as well. And I think something that people don't always think about. If you're from like a specific region, there might often be a specific regional fund that only invests in your region. So I put a couple of examples here, like the Midlands Engine Investment Fund is around obviously around the Midlands, but like around Nottingham and Birmingham and places like that. So they invest solely into companies in that region. So it almost makes it a little bit less competitive because you're only sort of going up against companies in your region. So it's always worth just finding out who your regional fund is and reaching out to them. Obviously, alongside this, it's always good to sort of reach out to a list of other investors and VCs that you think will be interested in the sector as well. Over to you, Julia.
Cool. So now that you've potentially identified like who you want to reach out to, if it's more private investors, if you're going for crowdfunding, once basically you've done that step of identifying who your target investor is, then you want to keep those key pitching principles in mind. At SeedLegals, we've seen that 3 of them are kind of the go-to, but again, they're things that you can always work around. The first one is keep it simple. So keep it simple. Basically, there's a principle in psychology, which is when you have a conversation, people only retain 5% of the content that you say. And that's only if they are actually engaged in the conversation. So if you're speaking to somebody who's thinking about something else completely, they'll retain literally 0%. Maybe they'll retain your face, depending on their kind of memory. So what you want to do is keep it short, keep it simple, go to the point, right? You want to make sure that you are talking about what you're doing, what your problem is, what your solution is, why you're doing it. And then you can see at the beginning if they're interested or not. Ideally, you want to kind of make yourself memorable, but keeping it simple will really kind of make you understand if you need to give that person more information or if you just need to stop and potentially go back to them at a later stage. The second principle is tell a story. So at this point, when you're early stage, most investors will invest in you rather than in the company because they invest in your ability to take that project from an idea or kind of an early stage project to an actual company that will generate a lot of revenue and that will make their ROI quite important. So that's what you want to, basically they're betting on you. So you want to make yourself really available and motivated, and you want to show you're passionate about what you're doing. And then one thing quite important is to basically think about the investor that you're speaking to. So if you're speaking to a VC, they're going to have a different mindset than if you're speaking to a high net worth individual that is only interested in SEIS, for example. So you want to make sure that you are really targeting the right people, but then you are also adapting your pitch to the person that you are actually speaking to. And that's what we're going to look at in another slide later on. So now that we have the target audience and now that we have kind of the pitching principles, now we're going to look into how to actually stand out from the crowd. So how to make yourselves as memorable as possible. So what we want to do is get yourselves into the investor's mindset, as mentioned. So there are about 6 things that an investor will look for in a kind of first pitch and company conversation. The first thing is the problem. So the question that an investor will have is, what is the problem or issue that this new company or that this person is trying to solve? Is the solution provided actually accurate and relevant? Also, does the founder actually understand the importance of that problem today in society or in any kind of business areas? And does the founder have a particular opinion on that problem? So, why does that person want to tackle that problem specifically? And then the product, basically as simple as, is that product actually solving that problem that, if the problem is here, if the solution is useful, then it's kind of a no-brainer in that situation. So for the product and problem, it's quite simple to demonstrate. Then you have the SEIS and DIS. So I have a slide right after this to kind of deep dive into SEIS and DIS. And I think John at the beginning mentioned that you had just done advanced assurance. So broadly, SEIS and DIS is a way to generate interest from UK investors. It's a government scheme that gives companies a way to give investors a tax relief on their investments up to 50%. So it's incredibly popular in the UK. And then we have the markets.
Yeah, so an investor is obviously going to be very interested in how big the market is. For the business, and obviously because they are putting money into a business, they want to know that if it goes well, what's the potential for the business? So are they in a multi-billion-dollar market? So if the business does get to unicorn level and it's performing as it should do, it can make the returns for the investor and make them a return on their investment.
Yeah.
So you need to just make sure that there are enough people sort of experiencing the problem. I'm going to go into it in a little bit more detail later, but like, what's the sort of serviceable, attainable market? Like, what's the market in your area? And then how big can you grow, and what's the full potential? So they're going to be looking at that quite deeply, and they will do due diligence on that. So it's really good to just make sure that you know your market size and you can defend that when you're speaking to investors. Exactly.
And on that point of due diligence, they obviously do a due diligence on the market, on your company, but they also deep dive into who is the team made of. Like, do you have a co-founder? Sometimes we see that if you're a sole shareholder or like a unique founder, then sometimes it's a bit harder to demonstrate that you have the right balance. So sometimes it's better to have a co-founder. Sometimes having too many is too complicated. So again, depending on who you're speaking to, they will look into if you are having actually, like, if it's a great team or if it's a team that is still kind of building itself. The investor will ask themselves, like, okay, do I actually want to work with those founders? Have they already built a couple companies before? Do they have ambition? Are they passionate? So all those kind of things that you want to sell yourself in addition to selling your company.
Mm-hmm. And also on that as well is whether or not you could potentially bring in like an advisor into the company as well, someone that's got sort of industry expertise that you can kind of ask questions to. If you've got someone that was formerly at a sort of a big company in your sector, that obviously adds to that. And I think, Julia, as you mentioned earlier, especially in the earlier stages, if it's an angel investor, they're going to be investing in you and your team, like, as well as the company. So they're going to be working with you. It might be for another sort of 5, 7, 10 years. So they want to be making sure they're working with the right person. So just showing that you're you're the right person for them to invest in. And that kind of leads us on to resourcefulness as well. So an investor will want to see that you are resourceful. And this can often be proved by what you've done while you're bootstrapping. So for example, you've managed to build an MVP just using your sort of network of contacts. You've managed to get early customers on without getting any external investment. Things like this, investors will really respect. And if you can get to a good point by bootstrapping, and it'll show sort of how impressive you are, which obviously reflects back on the team. And then finally, this one you probably have all heard lots of times is what's the traction, and not quite enough traction. So this is really important and can often be slightly frustrating for companies, because you kind of think, I'll come back to you when I've got more traction, but then you think, well, I kind of need the investment in order to get the traction to get the investment. So it's a bit of a sort of chicken and egg scenario. So traction doesn't always mean like getting revenue into the business and getting sales. Like you can demonstrate this in other ways, and investors will respect this. So if you maybe have built up like a list, like big marketing list, you've got a huge following on Instagram, different things like this. Even if you have some really early sales, like even if it's like sort of £1,000 a month or something like that, that's still great traction. It proves that people are willing to buy your product. And it
Hello? Important to ask them. Oh, maybe he's back. Okay, so let's jump into the next slide. The next slide does a deep dive into SEIS and DIS. So now that we've seen, okay, so that's the target investors that I want to have. That's how like my pitch needs to go. And then the kind of guiding principles of the investor's mindset. Then there's something that is extremely popular, as mentioned, in the UK at the moment. Oop, Tom, hey.
I'm back. Sorry, did I get cut off when I was speaking?
Yeah, but I think it was the end of traction. Was there anything else that you wanted to add?
No, that's a good. Sorry about that. I'm not sure what happened.
No worries. Yeah, so I was just explaining a bit more about SEIS and DIS. Basically, as an early stage company, you're seen as a high risk, right? For any investor, it's like, okay, well, again, like they've not really demonstrated traction. It's not the safest investment that I'm going to make. So the government created this scheme to kind of incentivize investors to bring in more money in early stage companies. And this is through SEIS and DIS. So a quick overview of those two. SEIS is up until £150,000 invested in the company, and EIS goes up to 5 million. So basically you have kind of a really long time to claim that relief and a really long time to continue creating that FOMO with investors. On the investor side, this is only for UK taxpayers. So it's only for angel investors or for SEIS and DIS funds. So maybe you've heard of Fuel Ventures, maybe you've heard of a couple others, but there are some funds that are dedicated to every year investing in like 50 different companies because they have a pool, like a really large pool of angel investors that want to benefit from SEIS and DIS. So you do have that long time to claim the SEIS and DIS. SEIS gives a 50% tax relief, and EIS gives a 30% tax relief. So it's still, you can see that it is still quite interesting even down the line. And there are a couple things to look for. So most companies that we help with, that we help get to a stage where they are advanced assurance, well, SEIS eligible, are companies in the tech industry, or are companies that are not doing the excluded activities that you can see here. So for example, if your company is doing banking, if you're doing leasing, renting, shipbuilding, money lending, all the ones that you can see here, it's a bit harder for you to get to a stage where you are SEIS and DIS eligible. However, yes, these are prohibited activities. However, I've seen that, for example, insurance, if you're an insurtech, sometimes it works, or banking, sometimes a lot of neo banking systems kind of work. So I wouldn't say that because you're doing one of those areas that you would never get SEIS and DIS. I would just say kind of look into it and try and speak to people that could help you out. We do that at SeedLegals if you're interested ever. But that's for SEIS and DIS. And now Tom is going to kind of explain how to build the most memorable pitch deck and what to put in your memorable pitch deck.
Thanks very much. Hopefully I don't cut out again and I stay with you the whole time. Cool. So yeah, I guess sort of being at Swoop for the last 2.5 years, we've reviewed lots of pitch decks and we kind of put together a bit of a template, which we'll also be happy to share after the call as well, if anyone is looking to put together a template and needs a few tips. So essentially, sort of answering the questions that I guess we were talking about earlier in terms of what the investor's looking for. This deck will hopefully kind of cover all of those points and should be a good success with investors. But I guess a few things to kind of identify first off. One of my personal rules is that I always like to have the deck below 20 slides if possible, just because it's short and it's punchy, and the investor is going to be able to get all of the information out really quickly. Sort of a lot of people might have heard of tools like DocSend and things like that. You can see how long investors actually spend on each pitch deck, and it is only sometimes a couple of minutes. So they need to be able to extract that information really quickly in order to make a decision if they want to sort of take a call or move forward. And yeah, make sure it's short, modern, and really visual. Obviously, a bit of a cliche, but a picture speaks 1,000 words. It's so much nicer to have a nice image than reams of text that it takes ages to read through. And yeah, make it really smart. It's similar. It's probably the first thing an investor's going to see of you. So similar to going to like a first interview, making sure you're dressed up nicely. Make sure the deck's looking smart as well. And now I'm just going to go into a few of the key slides we think to include as well. So I'll just whiz through these, and there is quite a bit of content. So like I said, I can share the template after the call as well. But first off, you want to sort of dive in, obviously give the information on the company and sort of the co-founders, and then also you might be able to put a brief tagline in saying what the raise is, and maybe a short sentence on what your company does, just so straight away the investor's like, right, I understand what I'm looking at, and off we go. And then from there, like a really short, simple, punchy sentence, which gives the overview. Probably put in your buzzwords there. If you're a B2B SaaS company or a B2C subscription company or a marketplace, put that in and tell them exactly what they do so they understand straight away. Because you want them to know in the first couple of slides, this is what I'm looking at and this is what the company does. And then the next couple of slides are really important. So the problem solution slides. So the problem, you really need to identify what your customer's current pain point is, and kind of what options they have today to help sort of tackle this. And you want to make it really real. So give live examples of what your customer maybe currently does and how sort of inefficient it could be, and like really why they're struggling. And then from that, you kind of answer your own questions and you give a solution to all of your problems. So you're a really great tech business and you're making employees much more efficient because you do this, this, and this, and just tell them exactly what your solution is to the problem. And then from there, you can kind of go a bit sort of deeper in. So slide 5, talk about your tech. If you've got a stellar team, shout about that. If you've got some nice IP and you've sort of developed something really innovative, it's a good time to talk about that as well. Also probably important at this stage to mention your traction as well. Like if you do have early traction, it's a good idea to talk about this early on in the deck. So the investor knows, right, okay, I've got a good understanding now of what the company does, and it seems like people are buying it as well. So I'm going to carry on reading and find out a bit more. The demo slide, I always think it's good to include stills. Like if it's a physical product, always include sort of pictures and images of the products themselves. If it's a tech product, maybe put some stills in. Even if it's just an MVP, put in the wireframes. Just make sure that you're showing kind of that you do have something physical as well and something tangible. And then from there, kind of you can add in sort of why are you doing this now? What sort of are there timings in the market? Are there trends that are happening that are going to affect and make you more successful? we just move on to the next set. And then, as we mentioned earlier, market sizing is really important. The investor's going to be very invested in this, like I mentioned before. They want to know, so you've got the TAM, SAM, SOM method, so of sizing, try and get these right, the serviceable obtainable market in the first instance, and the serviceable available market, and then the total available market. So if you get to the third stage, what's the whole market that you can capture? And being able to show those, if it's in amount of potential customers or amount in potential revenue, if they're to buy your product, is a really good way of demonstrating this. You might also cross over into a few different markets as well. So make sure that you are kind of doing yourself justice, I guess, and just making sure you're telling the investor that you are in a few different markets, and this opportunity is huge if they're to join you. Competition is always a really important one as well. And I've heard a few founders before say, oh, we don't have any competitors because we're doing something totally different. But I would say you always will have a competitor, or there's something that a person is doing that if you come along, they'll have to move away from that. So list out your competitors, be honest with yourself as well. So if you're putting yourself up against competitors, you've got to give them some credit in some places, and yourself, obviously you want to make sure that you're ticking all the boxes compared to the competitors, but you do have to sort of be realistic, because especially if you're comparing yourself to well-known companies. List the advantages that you have over those companies as well. Sales and marketing, like what's the plan? Sort of bring in all of these. This also goes into slide 11 as well. Like, what is the plan? What's the sort of customer acquisition cost? What's the lifetime value of a customer once you get them on board? And sort of what's the plan to go to market? Like, are you maybe going to sell B2B and B2B2C? So you're going to go into a company and hopefully they'll market your product out to their employees, which then become your end user. Or are you just going purely B2C, doing sort of Google ad campaigns and Instagram campaigns and things like that? And in that way, you want to also demonstrate your revenue model as well. So investors will want to see, revenue models. How do you make your money? Are you a subscription, or are you just sort of one-off sales? Are you an enterprise sales type business? You need to sort of dive in, and also maybe if you are a B2B SaaS platform, for example, identify the different tiers that you might have. So like if you've got one for a certain, like an SME, and one for an enterprise, if you've got different pricing, people will be interested to see that. And then within this as well, it's probably also good to sort of show your traction again. So you've got a certain amount of people in each category sort of spending with you. On slide 12, you can talk a bit more about the product and the tech. And then I always think it's great to include a roadmap. So you've probably seen those ones that are a bit like a snake. They go around. So you founded the company in 2019. You bootstrapped. You've got your MVP in 2020. You got some early stage investment in 2021, and then it sort of moves around. And where you are today, you might be raising your seed round of 500,000. And then what that's going to do is help you build the next bit of tech or get a certain amount of customers on. And then you'll do your Series A in sort of a year and a half or something like that. Investors always like to see that, so they have an overview of what the plan is and also what you've done so far. The team slide, like we said earlier, really, really important, and potentially you could move this further up the deck as well, like have it earlier on. Sometimes you see some really good decks where it's the second slide after they've just said what the title is this is who I am, this is what I've done in the past, this is why I'm doing what I'm doing, and then the investor sort of instantly knows you as a founder and what you do. And like I said earlier, if you have any prior investors, it's worthwhile shouting them out, because you've raised before, which is a good milestone. And then if you've got any advisors as well, people in the industry, they're good to shout out as well. And then financials, important to include, and as well as that, the ask. So how much are you looking for? Where's that money going? So maybe like a nice pie chart which has a breakdown of the percentage of you spending, say 30% of your raise on marketing, 40% on the team, something like that. And then give a brief overview of the financials. So if you're pre-revenue, what are the projections over the next 5 years? If you're revenue generating, what have you done the last couple of years and what are the plans moving forward? And investors will want to know this. It doesn't have to be too detailed, because obviously, but you want to have it on hand. If they want more information, you can send through the financials and the financial model after that. And then 15, I've kind of included in slide 12 as well. But yeah, just sort of making sure the investor knows the milestones is really important.
Yeah. So now that we've kind of spoken about what they want to see in the pitch deck and you know, who to reach out to, how to do that, etc. We have developed a way at SeedLegals to kind of like put everything in one place. Because the archaic way of doing it is, yes, okay, I'll send you, you know, an email with like a link to a drive, or I'll send you an email with like my pitch deck and then a presentation and then whatever, like a lot of documents that can be lost in translations. And so what we've seen is that we help you basically create your own URL page. So you have your own page with your pitch deck, kind of a video, like 30 seconds of, you know, who you are, why you do this. You also have like an elevator page, like who the main like key people in the company are, and it's like a one-pager to reach out to investors. And we've seen that most investors kind of ask for the easiest way to understand what your company does and what you do, and the quickest way as well. Because if we go back to the metrics of, you know, they only retain like 5% of the conversation, but a typical VC like will receive about 5,000 sort of applications or pitches a year, and they only look into like 10 or 15% of those. And in the end, they will make like 1 or 2 deals out of those. So to make yourself, like to give yourselves the best chances of going forward with them, the first step is definitely having everything in a clear kind of way. And one of the like most efficient ways that we've seen is a one-pager. The cool thing as well is that you can kind of track who has registered interest and things like this. But as long as you're prepared, you have all the documents ready, you have included everything in your pitch deck that Tom kind of went through, and you make it easy for them to get to know you and get to know your business. And that gives you like the bigger chance in front of anybody else. And then very quickly, if we look at the follow-up, so an investor is most likely somebody kind of, it's a cold outreach usually. So the best obviously is when you have like a warm introduction and then you kind of explain what you do, and then you kind of wait until they give you an answer. But there is a period where it's like, okay, they might forget about you. You might have met them at an event, and it's kind of the same mindset. You want to make yourself memorable, and you want to show them that you are extremely interested in having them as an investor. And so that goes with the kind of follow-up mindsets. So reaching out first is great, giving your pitch is great, but then you need to be persistent and you need to continue reaching out to them, asking them if it's a yes or a no, asking them if they want more information. And what we've seen is that when they are kind of hooked, when they have that first kind of interest, then what you want to do is you want to make sure that you have everything set up for the rest of those conversations. The goal is to take the conversation from a coffee shop or event, kind of pitch, interest, cool, the person seems nice, etc., to an actual, okay, so what do we do now? What's your valuation? Do you have a term sheet ready? How fast are you looking to move? What are your timelines? Are you trying to raise to scale? Like what exactly is your plan and things like this? So in your follow-up, what most investors would like to see is, obviously, if you have a pitch profile or like your pitch deck, a video like that helps. They can always go back to it without having to give you a phone call and things like this. Have your term sheet ready, as mentioned. So I don't know if everybody knows what a term sheet is, but it's a non-legally binding document. So it's just kind of a couple pages that state, okay, this is my valuation. These are the kind of share classes that we have. This is what the cap table looks like. A couple very broad kind of offerings. So it's just to kind of have a repository of what your offer is. And then again, taking that conversation to a bit of more in depth, but it's still not the shareholders agreement, which is more legally in depth. Then we always recommend for you to have your cap table and company's house filings sorted, because you don't want to reach out to an investor, generate that interest. They're happy, and then they do a bit of due diligence. They look on company's house, and they're like, oh, well, the company has been here for a year and a half. There's no confirmation statement. They just appointed a director, but that's not filed. It's just something that shows that you're not sounding as professional as possible. And what you want to do is have everything already. And if tomorrow is the day that they're going to invest, then you have all those documents ready and everything filed correctly. Then we also saw that most founders that already have a founder's agreement or have a document that says that they own their own IP, it cuts the time frame of the investment. So if you're prepared with a founder's agreement, for example, if you have a co-founder or a couple co-founders, it's just organizing the relationship between all of you will make it easier for a future shareholder to understand what the actual relationship is between you, like as co-founders, but also with the company. And that just cuts the time frame. And most investors, to be honest, will ask you for it either way. Even if you don't have one, they'll ask you to do one before the shareholders agreement. And then having a SEIS advance assurance, I think I went in depth on that, but it is extremely important to have that. It's not because you might think you're an excluded activity that you don't have a chance of getting SEIS and EIS approved. So most investors, they will look to see if the company can de-risk with the SEIS advance assurance or not. So that's basically it. And now I think we have some time for the Q&A. Thank you, by the way, for staying this long. I know that it is very tempting to go outside again.
Thanks, everyone.
Yeah, so I'm just gonna stop sharing my screen and then start looking at the questions.
Yeah, I can see one, which is a tricky one to get us going. How do you set your pre-money valuation? Always a very tricky question, and unfortunately, I won't be able to give you a specific answer in terms of a science you can go away and do. But there are some different methods, kind of depending on what stage you're at. If you're pre-revenue, there's things like the Burford's method, where you can sort of analyze yourself in different parts of the company. There's the scorecard method as well, which is worth looking at. Then if you're a little bit later stage, there's like the VC method and then sort of discounted cash flow. But what I would say is the best thing you can do is research companies that are in your sector and see sort of what stage they're at when they raised and what valuation they achieved, and then sort of compare yourself to those companies. So if they achieve 1.5 million, you think, well, I've actually got, say, FCA regulation as well, and I'm FCA authorized, so that might add a bit on. Yeah, just sort of have a look around and see what's there. But yeah, it's always a bit of a tricky one to come to a finalization on.
Yeah.
Tom, can I just add to that? I met with
it's
St. John, yeah. Sorry, Tom. I met with a really interesting investor last week, and Australian guy, and we were talking a lot about the business, and he said, don't put a number on your valuation at this stage. I mean, hey, we're sort of pre-development even, so it's a pre-seed idea. But he said, what you want to do is sell convertible bonds in your business. So get them to invest in a business at a certain level, and say after you've hit certain milestones, then you put, you basically put a value on it. And so giving yourself an outrageous valuation doesn't seem to be the only route. I just wanted to add that in because I really hadn't heard that idea before, but it seems to make a lot of sense.
Yeah, that's totally right as well. And I think Julia, SeedLegals can help with advanced subscription agreements as well, which is sort of similar to that, isn't it?
Exactly, yeah. So the way to kind of not define a valuation at this stage yet would be to use the equivalent of the SAFE. So it's an advanced subscription agreement. It's called the SeedFAST on SeedLegals. It's the equivalent of the Y Combinator SAFE. And it helps you, so you don't have to settle for a valuation now. You can settle on a discount on the future valuation that you'll do in the equity round. So maybe, John, that's kind of useful for you at this point, just because it's early, so you don't want to define and put, and set in stone a valuation, but you could kind of get investment now to get you to that higher valuation later in your funding round, definitely.
Yeah.
I also saw that you mentioned, oh yeah, Tom, do you want to say something?
I was just going to say, in terms of not putting a price on it, I think it's good to have something in the back of your mind where you know what you think the company's worth. But then you don't have to lead with that. So if you start speaking to an investor, you don't suddenly go, I'm looking for 150K at 1.5 million, because then they'll be like, oh, I'm not sure about that. I sometimes would recommend maybe you don't have to lead with the valuation and say it straight away. You can sort of come to that conversation once you've got to know the investor and you've kind of made a relationship with them, and then you'll be able to defend it and have a conversation around it, rather than them sort of getting turned off because you put a high number in sort of too early on. It's just what I always recommend.
Yeah. Yeah, 100%. I agree with that. Like if you look at the structure of the SeedFAST, you always have to choose what happens if you actually don't end up raising, because that discount, what would that discount be? Like, you know, how would the money be converted? And so you choose that floor, which kind of helps you have that mindset, because again, the SeedFAST is money now, shares later. So the shares later part becomes interesting. If you're doing a round and you have your valuation, that's great. But if you're not doing a round and don't have a valuation, then you have that floor that you've chosen before to kind of fall on. But definitely 100% agree with what Tom mentioned. If we look at other questions, there's one about the solo founder on the pitch deck. Do you have any advice on that, Tom?
So yeah, I can see a couple. There's one saying the sole founder problem is not found to truly affect investability. Yeah, and there's also another one that says if you're a solo founder, in terms of the team slide, is it okay to put in prospective individuals? So yeah, to I guess answer both of those, it wouldn't affect you that you are a sole founder. It just might be good to sort of identify whether you have some advisors or people that you do have sort of helping you out. And like I said about the resourcefulness bit earlier, if you can prove to the investor that you've bootstrapped really well, you're a solo founder, you've got the business to this point on your own, working on your own, then that's equally as impressive. And then on the second part, can you put someone in prospective individuals? I'd say only if you've had the conversation with them and they're happy to be sort of included as that, then I think that's fine. Like you can say, it's like a part-time CFO or something that's going to fully come on board once you raise the investment. But yeah, obviously you want to have that conversation with the potential colleague before sort of putting them on the deck and singing about it. Yeah.
I also saw a question about, I think from Tony, investors do due diligence on us. Do we need to know how to do the due diligence on investors? That's a really good one. It falls down to a couple of things. So we have like a couple principles, and there's a really good article by this person called Isabel Russ on Speed Invest, and it's basically on Medium, but she works at Speed Invest. And there are 3 like steps that founders kind of need to look for when they're doing due diligence. The first one is asking your current investors network if they know about them. So if you're too early stage and it's the first time that you're raising, obviously that's not an option. But if, as Tom mentioned, like you have advisors, or if you kind of know anybody in the ecosystem, it's always good to ask, because it's not because you ask that they're going to say, by the way, you said that I was going to invest. Oh my God, I'm not going to invest anymore. That doesn't happen. So ideally, if you can ask your network just for a first couple of information, that would be quite useful. And that's like the first part of the due diligence. The second one is there is basically there's a website called Landscape. So it's like Landscape VC, and you can check if they're on it. And then when you want to do in-depth due diligence, there are companies that could help you. There's one called Themis. I think that, I mean, a lot of founders that I help are using it, but it's sometimes when you really don't know the person. So if the person is abroad and you've never really met them, or you've not heard of them, but they seem, really legit, but you do want to do a due diligence, because if you have previous shareholders, you don't want to mess up for that new shareholder, right? So you don't want to bring somebody in and in the end, it's not a right fit, or it's not an actual investor. So there are ways to do your due diligence, just depends on which stage you're at and how you want to approach that. But I'm happy to share those resources as well. You can send me a message on LinkedIn or emails. But yeah, I hope that was useful. And then there's another question. For a pre-seed round, would you recommend getting all the fundraising documents ready and signing up investors as they offer capital? to invest, or waiting until you have raised the full round, then getting the fundraising documents ready and getting all capital from investors at the end? So again, really, really good question. How I can answer, like, it's hard to advise because it depends on the company, but in terms of data that we have at SeedLegals, the quickest way to raise is a hybrid model. So to explain very quickly, the traditional model is, okay, cool, equity round, shareholders agreement, term sheet, shareholders agreement, money as soon as everybody signs, you get all your investors. Time frame is usually 3, 4, 5 months, depending on how much you're raising. That's for a pre-seed, not a bootstrap. So for typical pre-seed, and then good, you send the shares and that's it. And you wait 12 to 18 months to raise again. That's traditionally, that was fine, but we have just seen, and it's hard to kind of say, okay, I need this amount for the next 12, 18 months. Like, so many things can happen. You might want to bring in more money after the round, or you might want to bring in more money before the round, just to get you to a stage where you can define a valuation, target the right investors, and prove to your investors that, again, you have traction, or those things. So the not traditional way of raising and the kind of more agile way of raising is to use the ASAs that Tom was talking about. Those ASAs, again, are money now, shares later. So it just helps you get to that next stage with, let's say, 10K from this high net worth individual that wants SEIS this year, or like 1K from a family member that wants to help you. It's just those little amounts of money that can just help you get to the next stage. And then you have your funding round where you can convert all of the money from the previous from the previous SAFEs or SeedFASTs within that new round. And then you also create some sort of FOMO, because people know that there are already people that have invested in the company. Potentially there are also advisors. Like, so many things can be taken into account, but for you, what you want to focus on is, get money now to go to the next stage, and then again, get money now to go to the other next stage, etc. So agile is the most popular way to raise that we've seen on SeedLegals. But it depends on your investors. VCs always want to go for traditional equity rounds, but yeah, it depends on who you're speaking to. So yeah, I hope that's useful as well. Yeah.
There's a question, where can we find reliable market size information without needing to buy market size reports for the industry your business is in? This is another slightly tricky one, really. Unfortunately, there's no real sort of really easy way of doing market sizing, and it will be quite a lot of research that you need to do. But yeah, I think it's just a case of looking at competitor companies, working out how many people are in like a certain area that you might be able to target things like that. But yeah, it's just a bit of a slog sometimes, but a bit of a research project that can take a little while. But yeah, I've spoken to companies that have done it both ways, like done it through a company and that have done it themselves. I think both have been successful. So yeah, we've gone to the question, John.
No, actually, can I just jump in again to say, here in Brighton, we have something called the BIPC, which is, I don't know actually what it stands for, but it's in our local public library, and they have access to all sorts of Ipsos and Forrester, and like every market research reference material you can imagine. They buy these things at a discount nationally, and they give them to the public for free. So it's really worth checking out, because you can get like thousands of pounds worth of free market research, reports and materials, basically just by showing up at the library and asking if somebody's going to help you. So just a tip that I found really useful.
That's great. Thanks very much for that.
Yeah.
Nice one.
Okay, well, I think there are no more questions. So I'm just very quickly sharing the Landscape VC and the company called Temis on the chat. And I'm just going to stop the recording. My LinkedIn is Julia Toper. If you want to add me, I'm happy to answer any questions on there. Going to stop the recording.